Should you just own the S&P 500 index, and does that provide sufficient diversification? We're going to work through that in today's video, what makes most sense and what is the best allocation for you and your goals. As a reminder, I'm Ari Taubleib, a financial planner, and I'm here to help you retire early. Now in today's video, we're going to be working through the S&P 500 index, and is that sufficient, and really get a good understanding of what is that optimal asset allocation for you. How much in stocks, how much in bonds, and of that, what types of stocks, what types of bonds make most sense. So to start, what is the S&P 500? The S&P 500 is the 500 largest companies in the United States, and it's so often used as a proxy because when people say, hey, Ari, did the market go down today or the market go up today? They're either referencing this or the Dow Jones Industrial Average, the 30 largest. So what we're going to look at is what makes most sense when we're looking at our portfolio and our goals. And so the S&P 500, it's a good place to start, but in my opinion, it doesn't go as far as it could. Meaning if you just did the S&P 500, you wouldn't be in a bad spot. But I certainly think you could do better, and people often come to me, or really any financial planner, because they ask themselves, is there something I'm not doing? And you don't know what you don't know, which is why there's so much benefit from having that perspective. So today's video, what I want to start with is a few statistics. Now, some people say, Ari, are you trying to outperform the market? The S&P 500 is just a great index. Shouldn't I just own that? And here's what I say to that before going into some statistics that I think will be very helpful, is when we're looking at our portfolio, what we want to know is what do we need it to create for us? So do we need to outperform to achieve our goals? Well, the first thing I start with is how much are you going to want to live on in retirement? You might be watching this video and saying, I have no idea. I just know I want to be maximizing everything I'm doing. In the S&P 500, it's a great place to start. But the S&P 500 is the 500 largest companies in the United States, and there's a ton of other value out there: international, real estate, small companies, developing markets, emerging markets. And by just owning one piece of the market, we're leaving potential growth on the table. Not saying don't own the S&P 500. I'm saying let's certainly own it, but only in conjunction with other parts of the market. So when I'm looking at any investment, any index fund, any ETF, any mutual fund, I'm looking at it through the lens of not is it a good company, but is it a good company at a good price? Because ultimately, that's where the value is gained. So let's hop into a few statistics. The first being Dimensional Fund Advisors is a company, and they found that of all the stocks that are actively managed, so of all the mutual funds that have someone picking behind the scenes, 41% of them stayed in business and 59% are no longer in business. Only 17% of the funds that stayed in business actually outperformed the benchmark. Here's why that's important. The funds that did outperform, they don't even have long track records that help forecast performance over the next 3, 5, or 10 years. The reason that's important for you is because you might be saying, Ari, should I go pay an outside advisor to try to pick stocks and outperform? Well, you certainly could, and it could work out for you, but history has shown paying that additional fee does not come back in terms of additional performance over the long term. So I would rather see you keep more of that money, pay for what brings value, don't pay for what doesn't. Now, if there was data that showed there was one fund that could consistently outperform the market, I would say it's worth paying the fee. Clearly, if we could know that paying 1% would give us 4% more of performance, well, that's a very easy decision. And I would say everyone should be invested that way. But history has shown that over time, it doesn't pan out. Meaning 1 year you might hire an advisor who could outperform. And you'd say, this is really great. The next year he doesn't just underperform, but you also have to pay him his fee. And so does it make sense to take that approach, or does it make sense to take a different approach? Well, you might have heard of a hedge fund before. What a hedge fund is they are trying to outperform the market. And what they do is they charge 2% of assets that under management and generally 20% of the profit that they make. Why is that important? It makes it very difficult to beat an index after all of the fees are taken into consideration. The S&P 500 index, I'm going to hop into their performance. The S&P 500 index, it has a total return of 267% over the past decade. That's an average return of 13% per year, which if you're hearing this and saying, hey, Ari, that sounds great, I want that, keep listening and watching this video, because if the S&P 500 were to return this every year consistently, everyone would be in it. But check out this example. If you put $1 million into the S&P 500 index 10 years ago and you didn't contribute anything, it would be worth $2.6 million today. And you're saying, Ari, that's a really, really strong return, which it is. The historical average of the S&P 500 is 10%, but the past decade, it's been 13%. But let's say we go 10 years back. So not 2010 to 2020, or realistically, 2012 to 2022. What if we go 2000 to 2010? What would have happened there? Well, if over the past 10 years, the S&P 500 index received 10% per year on average, why wouldn't we own that? Here's why. The reason is because it doesn't mean just because it performed great the last 10 years that it will continue to do so. Meaning, if you look at the S&P 500 index from 2000 to 2010, it did incredibly poorly. If you invested $1 million in 2000, didn't log back into your account until 2010, your $1 million, well, it's now worth $910,000. So you would say, Ari, I did what you said. I held for 10 years. That's long term, isn't it? Well, I logged back in my account and I had $910,000, which you might be saying that's a really bad return for what I was hoping for. So that's a loss of 9% over an entire decade, all while inflation was increasing. So you didn't just lose 9%, but inflation was growing at the historical average of 3%, which means you really lost almost 12%. So should you be trying to time the market? Well, if you tried to time the market, then all of a sudden you might get really lucky or you might get very unlucky. Now, you might be saying, I want to bet that, or you might be saying, can I hit more doubles and triples and really have a consistent return of 7, 8, 9, 10% over the course of my lifetime, as opposed to years of 13 and 14% in other years of negative performance. So how can we ensure you are well diversified? Well, if you also own international investments, emerging markets, really, really diverse investments of different stocks, well, if you are diversified within the United States, not just, once again, the S&P 500, is that return would have been more like 8 or 9% throughout 2010 to 2020. And so the way you win by retiring early is by not losing. You win by not just trying to pick winners and not just being sad by losers, but by saying, can we cast a wide net and use that net to capture all of the growth that's occurring all over the world very intentionally. And so where does the S&P 500 index fit in my portfolio? It's great. It should be a large piece of it, but it depends on those goals. And if you're a growth investor in the beginning of your career, you may want the S&P 500, but to a different degree to someone in retirement. You have different goals. You have different income needs. You have different expenses. Your tax strategy is going to look different. So it completely depends. For a full overview, the S&P 500 index is a great place to start. If you own that right now, not a bad place to be in, but I certainly think you could do better by diversifying further to both increase your returns and decrease the risk and still be on track for whatever your goal may be. That's why people do a retirement plan. That's the benefit of a strategy. I'm Ari Taubleib once again. I want to help you create not just secure retirement, I want to help you be able to retire early, and whatever that goal may be, that's what I love doing. So if you found this video helpful, please do share it with someone else who you know wants to retire early or you think might even find value from this video. Please like and subscribe this video, and I look forward to recording more to help you.